Hi everyone, welcome to another honeystocks.com stock market outlook video, which will be going out on Saturday the 16th of July. Now, before I do the usual and switch over to my screen share and walk you through many of the charts that have come onto my radar over the course of the last week, again, I want to take the opportunity just to thank everybody for a lot of nice messages, a lot of nice emails for the work that I've been putting out over the last few weeks. I have been a little bit more active on social media, and I hope you appreciate the work that I put into it. Now, of course, the market has had another decent week. There are some charts that are incredibly interesting to me at the moment. I think we've had a huge print in inflation, and how is that translating into the markets? Well, as we know, over the course of the last few days and really for the month of July, the market has outperformed its seasonality, which is very, very interesting to me. Again, I have some charts to show this, and of course I will walk you through it. Now, if you have just stumbled across my work for the first time, couple of things to get out there just straight off the bat is I am not a day trader. If you are someone that is trading on minute time frames, you're probably not going to get some value from my work. I'm really looking for longer term trends in the market, generally weeks to months, but of course the market has really been more of a choppy swing trading type of environment over the last few months, and of course my work has had to adapt a little bit to that. But generally speaking, if you're a day trader, there's no point in watching. So let's dive into the charts. Let's see what the market's telling us, and let's see if we can find some stocks and some ETFs that look interesting. Now, as always, before I get into this, please do pause the video, make sure you're comfortable before watching any further. It basically says there's not any investment advice. Don't be silly, do all your own due diligence. Maybe just to give myself a little bit of credibility, I'm working my way towards my CMT, technical analysis, is something that I'm very widely known for in professional circles. A few of my recent big calls, I understand in this game it's very much a case of what have you done for me lately. Made a call on the top in energy. If you pick up my weekly letter on the 8th of June, where this all started way back in November, made a call on a top in the small caps, which, as I'm sure most of us know, is a good gauge of risk appetite in the market. Of course, we know what happened after that. We've seen the same thing with the S&P 500 2 months later, again 5th of January. I do not use magical hindsight indicators, and of course if you picked up my letter back in January, you'll know that this was the headline. Now, you can go a little bit further back with my work, how I got ahead of the 2020 crash. Uploaded onto my website is the analysis that was provided to our clients and members the week before the crash. So hopefully you find some value, and if you are wondering what my work looks like for my clients, etc., then feel free to go and check that out. But if you do get some value from this video, please do like and subscribe. It all helps with the YouTube algorithms. So I've talked about the inverted yield curve quite a bit over the last couple of months. Now, with the yield curve, it's continued to decline. Now, we typically know that stocks don't tend to do very, very well when the yield curve inverts. It's a accurate predictor of recession, and again, stocks don't do too well in recessions. I think that's probably widely accepted. Now, the big question that we have is with the CPI prints that we're seeing 9.1%, and I know that for many the day-to-day cost of living is going through the roof. The big question is, how long is a recession likely to last? Now, I don't have the answer to that. I'm not an economist. I'm not going to pretend to be an economist, But what we can do is use the charts, and the charts will help us to identify areas in the market that could potentially help us to manage risk a little bit better. Now, this is a chart that maps seasonality for the broader market. Now, the chart is a little bit busy, so let me just walk you through this just for 20 seconds. Top chart is the S&P 500. We can see that this tracks over the last 70 years from 1950 to 22, how each month has performed in the S&P 500. We know and we can see from the chart that July has historically been a decent month for stocks. Now, what I want to draw your attention to is this little diamond. This diamond tells us how month to date is going. As we can see, despite all the negative headlines, despite all the nonsense that you will likely be watching in the mainstream financial media, stocks are having a good July. Now, of course, that doesn't mean all stocks are having a good July. Many stocks are having a very bad July. But when we understand that these indices, and we look at triple Q, we're seeing exactly the same thing. July is outperforming its seasonality at the moment. The small caps, again, massively outperforming its seasonality. We are only halfway through the month and we have a massive earnings season coming up. I think most analysts are expecting a decline in earnings. I think, again, that's probably not going to break the internet, but certainly something to pay attention to. When I checked the charts this week, it did actually surprise me that we were outperforming this month, but there we are. Now, this is the chart for the S&P 500. Now, I got a lot of questions on this over the last couple of weeks. Now, we know that the big banks, the investment banks, the JP Morgans, Jamie Dimon this week was painting more pictures of economic hurricanes coming, and I think what I fully understand with the markets is not really to pay attention to what the investment banks say. It's more a case of what are they doing. And although this is Michael Burry's bearish target for the market, the bear case for it is that we undercut the previous market crash lows. We've done that a couple of times. I try not to listen to the investment banks or the analysts. I prefer to look at things like the US dollar index. The US dollar index has been a massive headwind for stocks over the last 6 months. It's no coincidence that the US dollar index has been ripping and the S&P 500 has been going down. Now, I have a chart just to illustrate that in just a second, but what I want to draw your attention to with the US dollar index is that we are on the weekly chart approaching an overbought level. Now, we know that when RSI, which is just a tool that helps us to look at momentum, when we reach historically overbought or oversold conditions, it's reasonable to expect some kind of pullback, or in the case of if it being oversold, some kind of rally. So we are overbought at the moment, so that would suggest that we could potentially be looking at a short-term decline in the US dollar index. Now, what would a short-term decline look like? I don't know at this stage, but this is a very, very basic chart that I've built out just to illustrate that this is the US dollar index going up and that's the S&P going down. Now, of course, with the inverse correlation that we have, if the US dollar index is going to decline, logic tells us that the S&P 500 could catch a little bit of a rally. Now, let's not get things twisted here. The stock market is in a bear market. It's a very clear bear market. We haven't, in my opinion, seen any massive rallies. We've seen some big rallies in a lot of the beaten up names which have ripped 30-40% and then continued on their declines. Those areas of the market have rallied, but we haven't really seen what we would typically see in a bear market, which is where the major averages really catch a bid. You know, they can move 10-15% higher and then continue their drop off. So I've very much got a case of my eye on the US dollar index at the moment. We already know that the 10-year Treasury note yield is potentially looking like it's rolling over. The big question I have at the moment is I'm not 1000% confident that this is a rollover at the moment. Yes, we do have a bearish divergence, but if we look at what happened with the US dollar index recently, where it broke out, it looked like it was a failed breakout, and then it went again. This is what you would call a false start, and it's very, very typical. And it's why a lot of my work is really focused on having wider stop losses, risk management protocols than what might typically be advised by your day trading gurus all over the place. So I've very much got my eye on the 10-year Treasury note yield. If the 10-year Treasury note yield was to roll over, we would then be looking at an environment where the Treasury bonds, the ETFs, TLT, etc., could potentially start to move higher. Now, again, I have made a potential bottom call on TLT. I've got a few of my clients have already started to move in on these positions, but the caveat is that certainly it's not one of those where you would want to take your eye off the ball. If this starts to decline hard and we see the 10-year Treasury note yield start to rip higher, again, you would want to be managing risk at that point. There's no point in sitting through a position that's going to draw down 10-15%. To me, that doesn't make a lot of sense. Now, when we look at the major averages, and especially the Dow Jones, with earnings coming up and with so many big names due to report, if we just have a look, this is the earnings calendar this week. Just you can see here we've got Netflix, we've got ASML, looks like Tesla there. The big banks have already reported. The following week we've got Google, Amazon, Apple, etc. So the next 2 weeks are massive for the market. So what I would say is, with a lot of these charts, they are subject to change. I can happily change my thesis on 30 seconds notice. That is something that I communicate with my clients daily. So bear that in mind with the charts that I'm about to walk through. I am going to point out the key levels in a lot of these major areas of the market, because I think that if these levels do break and we do start to see the next leg lower, then that's an environment where certainly a lot of our clients will be, hedging positions, managing risk. And for me, the Dow, if we are above 295, the risk to reward proposition probably favours a bullish position. Now, again, this is a chart that I've had certainly built for the last 6 weeks. I've been looking at this as a potential support level. A lot of these levels are holding at the moment. We can see that with the Russell 2000, again, it is clinging on for dear life at the moment. Now, my message to our clients during the week was, yes, it's great that these levels are holding up, but if we start to see these levels break, we know the old adage, the more times a level is tested, the more likely to break it is. So certainly if the small caps or the Dow start to break below key levels, you generally can expect the rest of the major averages to follow suit. But I have been putting out bullish charts to our clients and members over the last few weeks. I just want to be very, very clear on that. Because of the risk to reward proposition, we can look at something like the triple Qs. We know that with the 200-week moving average, historically, it has been a decent level to buy stocks. So again, this is part of my thinking at the moment. But again, I'm very, very flexible here. If we do start to break below this 200-week moving average, then that's a big problem, and that's full-on bear mode for me. We had the banks report over the last few days. For those of you that picked up my letter during the week, I was essentially saying that rather than listen to Jamie Dimon and his scaremongering, I don't trust any of the investment banks. I'm looking at things through the lens of what if these charts hold up. Now, that's what we've seen with the financials this week, that they have reported. We know that Citigroup moved, I think, 10%, Wells Fargo 7-8%, JP Morgan caught a bid on Friday as well. So at the moment, in my opinion, the financials are holding up at the moment. And again, the risk to reward favours the bulls. But again, be very, very mindful that if we start to break below these financial crisis lows, then that's a big, big problem. So that's something that this is a chart that is very, very important for my work at the moment. We are probably going to see some kind of resolution, in my opinion, with XLK over the next 2 weeks. This is the key level. This is one of the charts from our client and members ETF chart book. And certainly we know that with XLK, they have some big holdings in there. And many of these will be reporting over the next 2 weeks. So if these levels again start to break, that's likely a problem for tech. We know that emerging markets have already posted a 52-week low this week. So that isn't great news if you are invested in emerging markets. But what I would note is that there is a bullish divergence there. There are some signs within China, despite some of the declines that we've seen over the course of the last week. There are some signs in China that a lot of the individual China tech names are starting to kind of put in base bottoms. So that might be something to keep an eye on. The biotechs bottomed a few weeks ago. Again, another one of the charts from our client and members ETF chart book. Biotechs are up 35% from their lows, bounced from a very, very logical level, and doing very, very well. Long may it continue. Again, key level for industrials. The industrials and the financials are very highly correlated, and certainly if the industrials start to break down from current levels, I think that's a big problem for a few of the names aligned. We know that Boeing has, very similar to biotechs actually, the Boeing chart has rebounded spectacularly from historic support levels, so that's one to maybe keep an eye on. We've got the healthcare, again, put in a potential failed breakdown, and it's now back into its sideways range. Healthcare has been terrific over the last few weeks. If you want some additional charts, I put out an analysis last week with a lot of individual stocks that might be of interest to some of you. Leisure and entertainment, I think certainly that there's not really a case, in my opinion, at the moment for looking at the leisure and entertainment really sector, primarily because we know that inflation is rising. A lot of families don't really have the spare funds, I guess, to go and spend on, you know, theme parks and Starbucks and McDonald's, etc. So that's one of the reasons why this area of the market has been hit a lot harder than others. We know that the timber and forestry ETF put in a massive 15-month top. Again, another one of the charts from our ETF chart book. We've got metals and mining. I've got my eye at the moment on Freeport-McMoRan. I think with metals and mining, again, it has rebounded from logical levels. It's not to say that it can't keep declining and we're looking at a little bit of a rally, but there is a little bit of a bullish divergence there. But something that I got a lot of messages on last night actually is I put out a tweet, and it was really regarding Nvidia. Now, for those of you that don't know, Nancy Pelosi is one of the greatest traders of all time, and rather than be the guy that screams at the computer and, you know, how is she allowed to do this, I actually prefer having the information to hand because we can profit from it. Yes, it's not ethical in my opinion. Yes, she uses information for her own advantage, but I'm perfectly okay with it because I can use that information as well. So Nancy Pelosi's husband has just invested millions of dollars. I think the number was around 5 million into Nvidia over the course of the last few weeks. And lo and behold, on Tuesday, the Senate are looking to push ahead with a semiconductor manufacturing bill, which, as I'm sure most of you watching this might understand, could potentially be a bullish catalyst for a lot of stocks in the semiconductor space. Nvidia is obviously a massive component of that. So yes, I get it. It's not ethical, but we can use the information as well. Do not lose sight of that. So my chart for Nvidia over the last few weeks has been really along the lines of we could potentially test 115. With this information to hand, I'm not certain that's going to play out. It will certainly be a case of, is it going to be a case of sell the news if the semiconductor bill gets passed? So that's certainly an area of focus for me over the course of the next few days, waiting to see if anything actually comes of this. To those of you that reached out to me via email, for those of you that don't know, I put out this chart for INMD on the 8th, just highlighting the 50-day simple moving average as a level that might potentially be a bullish catalyst for the stock. Lo and behold, INMD ripped, I think, 15-20%. Now, again, thanks for those of you that reached out. I know you've done quite well from it, but it is looking like it's trying to break out from a base bottom. We put this to our clients 10 days ago, and of course in preparation for a potential move here. That's exactly what we've got. For those of you that don't know, I called the absolute top in IMD, and I am looking to potentially make a bottom call here. It's a case of waiting to see what happens with a lot of the earnings, but INMD have come out and done their usual over the course of the last week, and they pre-announced and raised guidance, I believe, as well. So for those of you that are holding INMD, congratulations. It's been terrific. Long may it continue, and let's see how far it wants to go. Again, another chart we put to our clients last week was with Apple, just highlighting the Fibonacci levels for Apple make a lot of sense to me, and the 38.2 retracement level has been holding up very, very well. Of course, we've had a move from 130 to 150 over the course of the last few weeks. So certainly I think Apple is one of those stocks that's held up quite well. We've got Microsoft holding up pretty well at the moment. Again, this has been my chart for quite some time. I think with something like Microsoft, it's very, very easy. If we start to undercut the lows from last month, then that's a big problem. But the trend line support looks like it's holding up at the moment. Of course, that is subject to change. We've got the ARK ETF. Now, I've had a few questions on this one as well. This is a chart that I've been putting out to social media for a number of weeks. I think with the ARK ETF, it's very, very straightforward. What happens with the small caps will be key. I know that certainly with a lot of our clients and members started to cash in as it approached the $50 level. But the question I have is, if the small caps do catch a bid, what will happen with ARK? Well, if it gets above $50, I think you'll probably see Cathy Wood doing the rounds again back on financial media, and she's taken a lot of heat recently, but I'd love to see her stick it to everybody, if I'm being honest. And above $50 I think makes a lot of sense. We've got AMD again holding up at the moment. Again, I put out this chart a couple of weeks ago, and the support level in place has been holding up pretty well. We've got FCX. Now let me just condense this chart a little bit just to show you again how I use technical analysis. I don't overcomplicate things. I think for me, we can see that when RSI gets historically to these levels, it is reasonable to expect some kind of oversold bounce. Now, a couple of weeks ago, we actually got that. We got I think it was a 6 or 7% upside move overnight. But what happens is typically what you find with stocks that either break up or break down is they do and they put in what's called a retest, and all that is it breaks down and then it goes back to retest the level that it's just broke down from before continuing on its downtrend. We call it polarity, but I am still looking at this through the lens of, is this going to put in a failed breakdown? We all know that Freeport-McMoRan is a great company, but for me, it now needs to get above $30 to be interesting. I'm quite happy to just leave this alone for the moment. I think, yes, we understand that it's reasonable to expect a bounce, but don't lose sight that Freeport-McMoRan can just continue to chop around here with these RSI levels and for the stock to keep declining. So just to clarify, the level in Freeport-McMoRan is $30 for me. Amazon, I made a bottom call on this one a few weeks ago. I put out a YouTube video on this one. I will link that at the end of this video. And Amazon has held up above that $100 level. It's up 13-14%. And I think earnings will be the catalyst for this one in either direction. I think if this drops below $100, then it's full on bear mode. I think the PE ratio is quite high. We all know Amazon's a great company. Most of us probably have Prime at this point, but the stock really has done nothing for a number of years, and certainly if it drops below 100, that's a big problem. We have Netflix reporting this week, so the level to watch in this one is 205. I think if it gets above 205 on the back of earnings, then that might be a bullish catalyst. But I think going back to what I was saying at the start of this week's analysis, is it's difficult to imagine a scenario where stocks are reporting positive earnings in the current environment that we have. It wouldn't surprise me if Netflix report certainly the biggest subscriber drawdown in their history, just because of what we're seeing with inflation, etc. So it'll be very, very interesting. I think Netflix will be a good gauge of how the average tech subscription service kind of stock is likely to report in the coming weeks. So all eyes on Netflix for me. And we've got MicroStrategy. I think most of us understand at this point with something like MicroStrategy, it's not a name that you're buying for the fundamentals. It's one of those that's really a bullish or a bearish play on Bitcoin. Now, I argued a few weeks ago that MicroStrategy had already had capitulation. For those of you that don't know what capitulation is, it's something that we typically see at market bottoms. It's where everybody just throws in the towel and says, I can't do this anymore. A lot of people that I respect are of the mind that this is something that we need to see with the S&P 500. We need to see this with Apple. We need to see this with Microsoft, etc. I'm not necessarily against it, but I do look at these types of moves. 74.5% declines in 6 weeks. What you find with capitulation is the selling just intensifies, it accelerates, and then when you think it can't get any worse, boom, it just the market bottoms, and then it starts to slowly grind higher. So I'm making the case at the moment that MicroStrategy has potentially already bottomed, but it will be very, very dependent on Bitcoin holding on to that 17,500 level. I think below that level, MicroStrategy is getting cremated, and Michael Saylor is being liquidated. So all eyes on Bitcoin, but I just wanted to highlight this one because that's what capitulation looks like, and I think many probably don't understand what it looks like. So I hope you've had some value from that. Please do like and subscribe to the channel. It all helps. Like I said, let me know in the comments if there's any stocks that are on your radar. But if you have just stumbled across my work for the first time, feel free to go and check out our website at honeystocks.com. We provide memberships for our premium work. Every single weekend to our clients and members, we provide our premium weekend analysis. We provide investment ideas, the midweek halftime report. We've got access to a wonderful investing and trading community. I've touched on my chart book already, but all of our clients and members have access to my ETF and commodities chart books. And if you are somebody that would like to learn technical analysis, then you also have full access to our complete technical analysis program, which I used to charge a lot of money for, but now only include it as part of all of our memberships. And with our memberships, you also get a 7-day risk-free trial. But just to show you what our alerts look like, I'll just run through a couple of recent ones. This is the commodity index, which started to roll over, has done very well for our clients and members lately. Zillow did very well. Box Inc. again put in a failed breakout and met our downside objectives. Cloudflare, this is what bullish charts look like, was massive last year. Antero Resources was an absolute rock star. I actually started covering this one on this breakout at $5, and of course it ripped $45. But I am very unique in what I do. I log on our website every single high conviction alert that has ever been sent out to our clients and members over the last 4 years. The reason for that is just to show the types of stocks I like to recommend, and the prices, etc. I'm not recommending penny stocks, pump and dumps, anything like that. It's generally quite solid companies, etc. I'm very flexible, long or short, but there is only one other investment research firm that does this, and they are considered to be the best on Wall Street. So feel free to go and check that out. But I think if you have a mid-term approach, weeks to months, if you are looking to get away from day trading, if you are somebody that trades on minute time frames and all that nonsense, just there's no point in signing up for my work. But if you are maybe looking to learn technical analysis, maybe you're just sick of hunting around social media and following Twitter and stock twits and YouTube, etc., and you'd like to find a bit more of a home, then again it might be a good fit for you. But feel free to do all your own due diligence and check out our website. But if you have stuck around to the end, I will link a couple of videos just now. But yeah, enjoy your weekend, and I hope to welcome you soon. Thanks as always.